Hi everyone, welcome back to another episode of Fraz's Capital Podcast. Eliana, how are you doing?
I'm good, thanks. How are you, Mike?
I'm good. We had a pretty interesting day today. So one of our major holdings, Syntara, reported an update on their major trial in myelofibrosis.
Mhm. Really exciting phase two results and a fast track designation for phase three from the FDA.
Yeah, it's helpful. It's a bit of a confusing day though, I guess, because the stock opened up 20% and then sold off and ended down about 1.5. I think Aussie Biotech's just so hard at the moment. Like you think on a day like this, where it's the most information, that we've had this year, this should be the biggest trading and was the biggest trading day of the year. But the liquidity is just so low. It's like 2% of the company or something changed hands. There's a number of, 5 and 8% funds holding stocks. So it's not really enough liquidity for people to enter or exit large positions. It was pretty encouraging data overall. I'd say the company's in a much stronger position than it was yesterday before the release of this data, or certainly the investment prospects are much stronger after this data than before yesterday. Because basically we saw that, the results they saw at the interim were continued. And now the next step is for them to find a deal or a funding partner or to raise money to fund this phase three.
Do you think that's something that could impact the liquidity if results that we just received haven't really shifted it much? Is that what it would take?
It's hard to tell. Syntara's always been a really niche story, right? You're talking about myelofibrosis. It's a different mechanism to the existing limited treatments for myelofibrosis. You have to get your head around that. It's not like breast cancer or prostate cancer or something that can easily capture. It is much more easily understood. You're talking about quite a rare disease and quite a niche treatment. I think the deeper you go on this company, the more you like it. So, they've got multiple Nature papers. They design their own molecules. These are drugs they developed, which is extremely rare and unusual in the market. In terms of what would bring liquidity, obviously, if they did a big raise and brought in a bunch of new funds, why is it low liquidity? I think ultimately the real question is like, why is the stock muted? Like, what was wrong in the results? Often, if it was a blowout result, you'd expect a strong reaction. And I think there's two parts. There's like market mechanics. I think it's quite likely that one or two funds want to exit because they don't want to take that 2-year risk, or they're anticipating a raise if they can't get a deal. In which case, they'll be backing themselves to get a lower price and don't want to hold the stock into the raise. If anything, they might fund it and get it after. That's all possibility. It's completely hypothetical. I think also there are a few question marks on the data which are worth discussing. So a number of patients were discontinued in the trial. So they still recorded good results. They saw symptom relief, but ultimately a number dropped out. I think the company chose to treat like very sick patients, so far sicker than equivalent companies in their trials, like their competitors at the moment. These are people that have been on JAK inhibitors for a number of years in some cases. So what happens with myelofibrosis is you get the scarring in your bone marrow, which means your bone marrow can't produce the right blood cells in sufficient quantity, so your spleen takes over. And then what happens is your spleen goes into overdrive and might go from half a liter to say 3 liters. Think of like a carton of milk as like 1 liter and go from half of that to three, inside you, which causes all kinds of other issues. JAK inhibitors kind of tame that a little bit, but the problem is you actually need those extra blood cells, and there comes a point where you're trading off, the symptoms from an enlarged spleen versus the symptoms of stopping your spleen from generating enough blood cells. It's pretty nasty. It's a pretty difficult position to be in, horrible scenario. And it's people right at the end of that when they've been taking JAK inhibitors for multiple years and they're about to discontinue it, after which there's no treatment. That's the stage at which, Syntara's drug's been tried. And so to see spleen reduction and pretty significant symptom relief in more than half of the patients, and at some levels of the trial isn't complete, up to 70% of patients is quite a big deal. It's also worth noting, like, the JAK inhibitors, they're measured based on reduction in spleen volume. Like, that is what they're there to treat. They're there to, like, fix those symptoms. And so reduction in spleen volume is really important for a drug that's targeting that mechanism. But Syntara's drug is upstream of that. They're trying to reduce scarring in the bone marrow, which should, with time, reduce the size of the spleen. And that's exactly what was seen. Even in these really sick patients, there were spleen volume reductions, but it was perhaps less than you would expect if it was a drug that was specifically targeting that. So it's actually pretty strong evidence that that the drug actually works. They saw spleen volume reductions, even though the mechanism isn't even targeting the spleen. So it's kind of a mixed bag. I think there's a huge body of evidence now that this whole class of drugs is antifibrotic. We've seen it in skin scarring. There's been 2 trials now in myelofibrosis, one as a monotherapy and this one combined with ruxolitinib. It's all pointed the right direction. The mechanism is coherent with the data. What we saw in this latest data release is very much in line with what we saw in the interim data. Like, there really is something. There's clearly a drug here that works. So now it comes into the kind of finance questions. Do they find a deal? Do they finance it? How do they go about the phase 3? We'll be chatting to the director of the company next week, so maybe we can try and some insight on that there.
Can I understand that their phase 3 trial will have 360 to 390 people participating? Do you think that having a larger spectrum of patients will reflect positively on the potential results and possibly affect how those results will be perceived by the market afterwards?
Yeah, I mean, they've done 2 trials. So the odds of 2 trials working randomly is extremely low. So if you had they're both small trials, but if one of them worked and the next one didn't, then that would have a big question mark. Kind of like what you saw, not quite the same, but in Opthea, I guess there was no dose dependence and different cohorts didn't necessarily perform in line with what you'd expect based on dosage. It's extremely unlikely that you would get 2 different groups, even in small groups of like, say, 16 patients, like in this trial, see a very strong, consistent effect, and then do it in another similar sized group and then see the same effect again. The odds of that happening are obviously much lower. The other part of the question is, will that change the patient population? Almost certainly. I mean, I think the evidence here is that you kind of do want to go earlier on, and the market is always bigger if you go earlier on in a disease, even if it's just because people stay on the drug longer. If it's antifibrotic, it's almost certainly going to be more beneficial to give it to people while they have more effective bone marrow and more effective blood cell production. You might be able to maintain that. And as we saw here, we saw kind of improvement, reduction in spleen and reduction in symptom scores. So maybe you can partially reverse the course of the disease in earlier patients. We don't know because it's only been done in very late stage sick people. So I'm sure that will be incorporated in. But the big question is now financing. How's it done? 360 patients are much bigger, much more expensive trial than 16. So will they get a partner? Will they try and raise the money on the equity market? What's the strategy? And that is something that we're just going to have to wait and see.
What do you think would be the most beneficial strategy for them?
It's a good question. The higher the confidence you have that it works, the more you want to raise the money. I think the reality is the share price is relatively low to the opportunity, so you have to do a 50% dilution. As a shareholder, if the money was there, we would certainly welcome that and probably participate on some tiny amount. This is actually the optimal time to kind of partner because you want a well-resourced partner. Firstly, you don't want resourcing to really determine the way you structure the trial, because the last thing you want is an inconclusive trial, like a trial where there's not enough, maybe the data is good, but there's not enough patients, or it's not entirely conclusive that it works. Secondly, ideally you do it with a partner that can commercialize it, and then they'll do it to the standard that they need, either to buy out the company fully or launch the product themselves. So it's helpful to get people a partner in, before the phase 3, so they can. And it's often why transactions happen at this stage as well, because a major pharmaceutical company will probably want to put their resources behind the phase 3 and design it the way they want to do it and handle that whole process with the FDA. So this is usually a pretty good time to partner. And actually, I'm pretty optimistic on the rest of their pipeline. I mean, they've got an antifibrotic they've designed their own molecules that stop the cross-linkage of collagen, which is in all kinds of diseases, from autoimmune disease like scleroderma to like skin scarring. They're working in Parkinson's. They've got so many different avenues that ideally you'd want them to partner this drug off, let another company, a large company, handle the development and the funding, and then use the money to explore the rest of their program. And I know there's really promising programs in all kinds of scarring in the tissue, because maybe you could apply it topically. You could obviously get it into where it needs to be in the body as well. I'd like them to pursue those, to have the resources to then pursue all the avenues that this could be used in. I think that's probably the best outcome for like patients in the world as well. So that would be my preferred outcome. partner now if they can. Partnering your deals is hard because it has to fit in with the strategy of the pharmaceutical company, and there's only so many of them. So everyone seems to assume that like you get good data and then you get taken out. It doesn't always happen. It still has to fit with what an acquirer wants and their existing franchise, their existing sales force, and their existing strategy. Like that's why pharmaceutical companies can pay up so much for drugs. Like if it's a new drug in an area where they already have the infrastructure, relationships, and the sales force, then it makes the most sense. If it's like if it's completely different to what their strategic interests are and where their existing resources are, they're probably not going to be interested. Now, fortunately, there are plenty of companies working in kind of blood cancers. Yeah, they're my thoughts on that.
What do you think of everything happening in Iran and Israel right now?
Good question. I mean, I'm the expert on that space. I think I thought it was really interesting that there's a Twitter account that tracks like pizza deliveries around the White House, and there was a spike.
Mm.
And he tweeted this, and it turns out, yeah, there was indeed an attack. The US also apparently sent out messages to embassy staff in the Middle East and brought some people home. So there were a couple of indications that something was happening, which I guess is now the modern world. Like the information will get out. I think the world is somewhat immune to these because there was a couple of flare-ups in the past. It's almost like if it's something completely new, then the market takes a long time to know how to deal with it. I think in this case, they'll be assuming there'll be some bluster and then everything will calm down again, potentially quite quickly. And so if it's like a risk that the market's comfortable with, you often get a short sell-off and then a very quick recovery. If it's something new, then that can take a lot longer and can be much scarier. I don't think, famous last words, I hate to make predictions like this, but I don't think it's the kind of thing that rolls things over. There has been a pretty strong rally now from the April lows. So it wouldn't be too surprising if you take 2 steps forward and 1 step back and still be in the context of a bull market. Like, for example, using the 200 days as a measure of the bull market or bear market, pretty much every index is just above now. Like it just crossed above. So we're kind of in the early stages of a bull market, which could run from 6 to 12 months or 8 or longer. And that's still our base case until something bad happens. I think it would have to be an escalation from here. Like an escalation that affected the rest of the world, not just like some scary blustering. Like something that affected energy markets and really pushed oil up, a significant amount, $20, $30, something that would move global inflation. That's how you'd have a mechanism. That would be quite scary. And you could see some downside there. But we've almost seen this too many times in the last kind of year or two, or even a couple of years, When it was the Russia war, that was 2022. I feel like the market's somewhat used to these kinds of moments and won't overreact this time. But we'll definitely see.
I saw some interesting charts this week from Morgan Stanley about AI and the rollout in China happening right now. So the article was about how there's an AI revolution and it's going to boost their long-term potential GDP growth and how they're implementing it into a bunch of different industries and sectors, and how all of their models, like DeepSeek 1, are based off of low-cost growth, and how their models are much more economically sustainable to roll out, and they're taking over so many industries. They have thousands of AI startups, open source, LLM, and data structures, 5G infrastructure.
Yeah, well, remember, DeepSeek used US, certainly Western LLMs to help train theirs. The interesting thing, there's a huge debate now in the US about whether they should ban chip sales. Like we've been saying from the start, this is insane. You're just cutting revenue off from Western companies and at the same time fostering domestic industries in every single critical chip functionality. That's exactly what's happened. And, Huawei's come out, engineered chips that are basically equivalent or almost equivalent to NVIDIA's. And you could always just stack these chips anyway. It's more about efficiency. It's not like just because you have less chips, you literally can't do certain workloads. It's just more expensive and harder to do. And so it's pretty clear this policy's backfired. And I have noticed that the conversation has changed and some more people in the United States are talking about this. we saw that it affected Nvidia's revenues quite substantially when the chip that they more or less designed for the Chinese market to fit in with the restrictions also got banned. So I think it's not something you can stop. I mean, they might be able to slow it down by months. I reckon it's probably weeks. And actually, I think this is the best. This is actually going to boost the Chinese long term massively, because instead of sending all this money over to Western companies who will then spend it on R&D and be dominant, they're now forced to find out domestic alternatives and be more expensive and slower in the short run. But in the long run, they're going to have domestic champions at every part of the supply chain. So it's a huge misstep from the West. And you're already seeing it. And has it slowed them down? No, of course not. Like Alibaba, DeepSeek, Tencent, they all have models roughly equivalent to Western models. So it hasn't even slowed them down at huge expense to Western companies, basically making some of them are going to lose their monopoly status over this. So it's a massive own goal by the United States.
Absolutely. And I think that there's some really strong competition in the sense that they're working on driving models that have less reliance on raw computer data. I think there is a chance that one day they'll be efficient, and especially if they're adopted at scale, which is their overall plan.
I mean, yeah, Chinese are going to dominate in this space. And it's also kind of the perfect thing for a state-run economy. They can allocate the resources, they can spin up huge clusters. It just suits them very well. The same way that it suits Amazon, Google, Microsoft over small startups. It's like such a big scale game. And the fact that the Chinese can mobilize their entire state, whether it comes to energy, whether it comes to, chip production, everything that's required is a huge benefit. So the AI boom has benefited, the hyperscalers, but also these like massive megastates.
Moving into a topic we haven't actually discussed before, what do you think of mining, specifically uranium?
Australian fund managers love uranium. I think it's had a couple of bull runs over people's careers, but it's kind of like also almost gone nowhere. I think it's been a very frustrating time for many, many years. Now, more recently, there's probably more legs than ever because you've got these new types of reactors, which have actually, we've had them for a while, but there's been companies that have listed, raised a lot of money, and are going to build them. You've got big tech companies saying they're going to build their own nuclear reactors. You've got this huge shift in the United States opinion, actually around the whole world, other than maybe Australia, after Labor won the election, and basically killed nuclear. Amusingly, they said they're going to cost $600 billion, but literally every country on the planet is building from a fraction of that. It was one of those claims that just got completely unchallenged. And yeah, I guess you have to be bullish, but it's complicated. I think you need to do a lot of work because there's like big stockpiles of it. There's a lot of optionality in these mines on how fast you develop them, how fast you build the mine, how fast you kind of mine the resource. We've spoken to a couple of uranium CEOs lately. They all seem pretty convinced that the price is going higher, but they almost seem like that's like a given. But, pricing markets is never a given. Like you just don't know. And if there's a wave supply and a ton of miners that can switch it on, like the handful of people that we spoke to in these mines, handful of miners, they have a lot of control over how fast they mine. And they all think the price is going higher, so they're going slower. So what if the price, doesn't? Then their revenues will be lower than expected, and the time value of these mines will push out. Or the price does go up, and then the supply response is much bigger than everyone's expecting. Because one thing I've never ever seen a miner or talk about like second order effects. Like I remember vividly in like one of the iron ore booms and busts, there was like a cost curve, and it was like the iron ore cost curve is like $80. So that's below $80, none of the mines, so much capacity will go out that the price will never fall below 80. And then everybody got these strategies, but no one thought, well, in that scenario, what happens? Well, in that scenario, engineers get laid off, people sack the consultancies, equipment rental goes down, the cost to build a mine like collapses. And so the cost curve is actually way lower than you thought. And it's actually those second and third order effects that nobody ever forecasts. Like people think, okay, we'll have higher prices, and there's like this is the supply, and the demand is much higher. It's not gonna so there's gonna be a huge opportunity. Well, typically what happens is maybe it spikes up. Maybe we just saw that, or we're going to have one of those periods now in uranium. And then a bunch of mines get funded. And then the fact that the higher prices brought on a number of new mines, funded mines, that's not taken into consideration. And then so in 2 to 3 years, they all come online at the same time and dump the price. And the price collapses. And the mines are built. So they just have to either go out of business or produce as much as they can. Um, and so I can see echoes of that in uranium in like the certainty that demand is in excess of supply, which is probably true. Certainty that the price is going to go up, but also everybody's kind of thinking about how they're going to react to price. They're not thinking how everybody else is, and how that's if the price does spike, all these like marginal projects are going to be funded. They'll be built. They'll all come online in a few years' time, and then you're going to have a mass oversupply. And so I think it's something interesting to watch. I don't think it's something we have to play in. I think you'd have to spend a huge amount of time to actually really get a grip on some of these things. And then also sometimes the work's not rewarded. Like how many energy specialists lost all their money in the shale collapse? Like it didn't really matter. It didn't really matter how much you knew about shale dynamics and global energy markets if you're on the wrong side of that. Of course, if we did do something, which I don't expect we will, we'll probably use our risk model. And that's extremely effective in these kinds of scenarios. We have these big up and down trends. Actually, commodities, other than maybe tech stocks and crypto, commodities is probably the sector where these kinds of momentum-based models are extremely effective. So, it's something we would, if we did do something in commodities, we'll do it in a very risk-managed way. We did look at the stocks. We did look at the ones that are doing those reactors. The problem is the good part is that they're very momentum based, like high short interest, they double, they triple, they halve. And actually since the last buy signal, they doubled. So I thought about it, but we didn't end up buying them. But the value is really hard. Like you're talking about revenues, you're talking about profits in many, many years' time, like even longer than our biotechs. And like we've already seen the troubles that we've had, the difficulties you have this year when you have revenues in 27, 28. There's times when literally nobody cares. And so at the moment, uranium's got everyone's attention, but it wouldn't take much for that to turn. And then there's no anchor, but there's nothing anchoring the stock. And so the reversals could be pretty sharp and hard, whereas that's, if you think about, at least tech stocks have revenues and most of them have profits now that we look at. There's got like an anchor, like, there's some value there. If you've got a project that may or may not be built in 5 years' time, it's much more nebulous and harder to make the investment case. Yeah, so that's our kind of thinking on uranium. What do you think, Eliana?
Looking at uranium, it sounds like there's so much potential for so many companies to succeed. However, it makes me really hesitant that a lot of these companies have been ready to roll out and start production for a number of years now, but haven't. And they don't particularly have long-term deals lined up, even though it's the safest option for securing future revenue, because they want to watch the spot price and determine if that's how they could make the most money. And I think that there's a lot of potential to also get stuck in a really dangerous position there if you're turning down and not securing long-term contracts to hold out for the spot price, and then for some reason in the future unable to produce larger volumes at the spot price if there's so many other mines competing for the exact same clients. And I think that there is so much room for growth, especially from US demand, looking at their low carbon emission goals and things like that by 2030. But then that's also stretching into 2040 and 2050. So like you said, it's a lot of long-term investing, which is interesting to watch, but not for the next couple of years, I think.
And the outcome of these, it's going to depend on their strategies. It's path dependent. It's not just even that uranium goes up. It goes up at the right time, and it goes up into a period where this particular miner has ramped up production, however many years or months previously, so that they can deliver into that market. And then there's like the competitive dynamics around winning supply contracts from the miners. It's not really clear. It's not a slam dunk for any particular company. And you'd hate to be right and then lose money. Like you'd hate for uranium use to take off and there to be nuclear power reactors everywhere, all around the United States, all around Australia, the world, and then actually the price collapses, which also happens often. Often you see these things succeed and then the price collapses and investors lose money anyway. I think it's something we'll watch. Let's keep an eye on it. Why don't we wrap up there?
Good. Thank you for having me back again today, Mike.
Thanks for coming on.